Good afternoon, everybody. Welcome to our webinar this afternoon on the subject of primary care networks. Where are we now? My name is Andrew Burwood, and I'm joined this afternoon by my fabulous fellow partner, Lizzy Lloyd, and we look forward to going through the session with you. I guess without further ado, I'm going to hand you over to Lizzy, who's going to introduce us to primary care networks and give us a brief recap of where we are.
So a brief recap of primary care networks, or PCNs. These were initially a 5-year, part of the 5-year GP forward view. So from 1920 to 23-24, because of the election, they've rolled over for a 6th year. But just looking at the 5 years that we did have, they started off as sort of a concept a little bit. We had core funding, clinical director funding, the extended hours, and we had 2 ARRS roles, which were pharmacists and one pharmacist and 1 social prescriber. So if you were a PCN of, say, 30,000 patients, before the you had the ARRS funding and about 100,000 of additional PCN funding, albeit extended hours was something that was put into the DES, so that bit wasn't additional. Look where we ended up at March 2024. We've got enhanced access, so we've got some additional work there added to the extended hours, £7.58. We've got leadership and management, we've got the capacity and access support and local improvement plan, which is not on this slide, funding. Care home beds were introduced. So some of it's paid on an actual and adjusted patient basis, which Andrew's going to cover later on. So we can't directly compare the additional amount of funding, but you're looking at, getting on for 400,000 of funding in the PCN. So really, need to be involved. In addition, your 2 ARRS roles that we had at the start ended up as 17 roles. They're now 18 for this year, and £22.67 per weighted patient. So this is where the funding has gone. We know the new funding hasn't gone into the GMS contract. The uplifts for that have been very low. We've got on top of this, obviously, investment impact fund as well. Recap again, what is a PCN? Well, a PCN is a directed enhanced service. It's sort of like a joint venture, a collaboration of GP practices. Maybe you could call it a partnership, a loose partnership, but it's not a separate entity, and that's going to be a theme to what we talk about today. Initially, the funding was paid to one practice. It had to follow a GMS contract, so it was paid to a nominated lead practice. That may still be the case for you, but you can now elect for it to be paid to a separate bank account. Whatever happens, this PCN money, even if it's paid to a practice, it shouldn't be muddled up with that practice's income. It should be immediately transferred into a separate bank account. We're not keen on it being netted off either. Just transferred all into one bank account, so you've got transparency. All PCN members can see the available funds. And it needs to be recorded and sets of accounts prepared, which Andrew will go through in a little bit more detail in a moment. Next slide, please, Andrew. So what are the core elements of a directed enhanced service? So as I said, 30,000 patients. So initially it was 30 to 50,000 patients, but we've got PCNs that are bigger than that. We've got single PCN, so a single practice that is a PCN in its own right, which tend to do quite well because they tend to be much more nimble and be able to make decisions because it's all within their one practice, rather than having to, elements of compromise and how you're going to integrate the funding and the services within maybe a few practices which are different. Most of the funding is work-based funding, as we saw with the ARRS roles on the recap slide. So the ARRS funding is so much per role, being the maximum you can claim, but of course we've seen that some practices can't recruit at that level of ARRS funding, and there may be some top-ups that have to be paid out of additional PCN funding, like core funding, or from their own practices. With the ARRS roles, there is this additionality requirement. So, yeah, it's going to be above the network's workforce baseline, and they're going to be engaged across the network. The spirit of a primary care network is the integration. So I did take a quick look at the data available on NHS Digita as of September 23, because that's when they tend to publish their experimental statistics, they call them. So there's 1,271 primary care networks in England. It is an England thing. You can see from the going back on that data how those numbers have grown. It may just be reporting, because not all of those primary care networks have reported their staff. So we've got most of the primary care networks reporting their headcount staff and their full-time equivalent staff. So we've got them separated there between the number of clinical directors and full-time equivalent. So obviously the full-time equivalent is less because clinical director funding is as a 0.25 of a full-time. Other direct patient care will include all your roles, your ARRS roles. Somehow the full-time equivalent numbers are more than the headcount, so people are doing more than full-time hours. So you do question the data sometimes. And then you've got some other admin roles, so they tend to be PCN managers. So the government's aim was to increase workforce by 26,000 by the end of this 5-year directed enhanced service. They actually announced in May 2023 that they'd reached this milestone quicker and had 29,000 of additional primary care staff. Not sure if that was headcount or full-time equivalent, but it's not all PCN staff, it's not all ARRS staff, so they've badged into their claim other increases in primary care network or primary care staff as well. So I think Andrew's going to take over now and talk about more of the detail of the PCN DES.
Thank you, Lizzie. One thing I should have mentioned at the start is we do have a question box on your desktop. So if you have any questions, please do use the question chat box, and Lizzie and I will do our best to deal with those whilst the other one is presenting. But we also have time at the end of this session to have any verbal questions or I still can't say it. One's written down, I'll try again, third time lucky. One's written down that we can go through as well. So please do make use of the chat box, and we'll do our best to cover those as we go through. But hopefully we'll cover everything that we want in the hour that we have. So this next slide is looking at the accounting necessities for the primary care networks. As Lizzie mentioned, the networks themselves, they are not a taxable entity or any sort of entity in their own right. They are a loose collaboration, or at least started off as a loose collaboration of practices coming together to fulfill the requirements of the directed enhanced service. As such, it is necessary for each network to prepare a set of accounts and work out the end of year surplus. Now, in the first couple of years, the surplus was coming primarily from the core funding, which is £1.50 per patient. We've got a slide coming up which talks about how the PCNs are funded. But in those first couple of years, the networks themselves weren't really spending the £1.50 on anything specific. It was perhaps being held back for future spend. As a consequence, that means that all PCNs would have made surpluses, at least in the first couple of years. And because of the arrangements, because of how that loose collaboration is working, it's necessary for each network to prepare a set of accounts to work out the share of surplus and to work out how that's shared between each member practice. Each member practice is then required to report their share of any PCN surplus achieved in their own member account, in their own partnership accounts. So that's really, really important. HMRC are fully aware of what networks are and how they are funded. And should you ever be subject to an inquiry by HMRC, they will definitely be checking to make sure that network funding is recorded in your accounts and the partners are paying tax on that profit obtained. So that's the first point. that's really, really important. Lizzie and I love a top tip, and most important thing is to make sure that you do prepare accounts for your network from inception in July 2019 onwards. And typically they would be prepared through to 31st of March each year so that the year end coincides with the NHS year. And Lizzie's already mentioned about funding being received. It's really important that the funding that belongs to your practice, your share of that, that's the only part that's included within your own partnership accounts, and not any funding that belongs to the PCN. So again, make sure that that is the case. In terms of software, we do recommend that you use some software for recording income, expenditure, or transactions going through the network. I think in the first few years, spreadsheets were quite common just to keep it quite simple, but actually using a cloud-based product such as Xero or QuickBooks would be entirely sensible now. One, it helps maintain a detailed record. Secondly, you've got an audit trail for all network members to have sight of if they want sight of it. And thirdly, it makes the preparation of those annual accounts much simpler. So if any of you need any assistance with software choices, please do get in touch. So next slide covers off common problems to consider. So the first one identified is working capital and cash flow. For the majority of networks that we act for, none of the member practices have been required to pay capital in to the network to provide funding for day-to-day requirements. And therefore the funding is primarily covered by the £1.50 received per patient not being spent. So that is really, really important. With the size and volume of networks now, typically how much money is coming into the network, and we'll see that on the next slide, having a solid working capital requirement is really, really important. And I think for most networks, it's not possible for them to distribute any surplus achieved at the end of each financial year in full to member practices. So that's something that really needs to be kept an eye on. And it's important that you work together with your accountant to make sure that working capital and cash flow is managed correctly. Now, one of the difficulties is that the partners, as I previously mentioned, do need to pay tax and also superannuation if they're members of the pension scheme as well on any share of surplus that the partnership has been allocated within the network accounts. So if you've got a situation where the network is not paying out bottom line profits to member practices each and every year, then there should at least be a payment to cover the tax and superannuation liabilities payable by the partners, because otherwise the partners are then relying on undrawn profits from the partnership to fund those liabilities, and it makes it incredibly difficult to manage practice cash flow and also partners' personal cash flow as well. So again, making sure that that's all joined up and looked at as a collective is really, really important. Now, that third point on the slide talks about how you account for income in the network accounts. The majority of income earned by the network relates to core funding. So you have your core funding £1.50, extended access, and then the staff roles reimbursements, ARRS. Now, in the vast majority of cases, you cannot defer any income, anything that's received, even though you may intend to physically spend it in a later accounting year. If you are working as that loose collaboration between you, as I mentioned previously, any bottom line surplus must be shown as income within the network and then shared between the network member practices. The only thing at the moment under that scenario where you can look at potentially deferring that income to be allocated in the future year is there's any elements of funding such as IIF, impact and investment funding. So with the IIF money, there is a clause within the agreement that the PCN must commit in writing to the ICB that any income earned will be reinvested to improve patient experience. Therefore, if you do have specific plans to spend that money in a later accounting period, it's possible that that income could be deferred to a later period to match the expense. Therefore, you've not got the profits being reported within the partnership accounts, and therefore the partner's not paying income tax and superannuation on that income. But you do need to make sure that you understand how the income is generated and how it has to be reflected in your own account. So again, if you need any assistance with that, please let us know and we'd be delighted to help. Next slide looks at current funding. So these are the numbers for 24-25. Lizzie has already gone through the funding from inception in 1920, but I mentioned core funding of £1.50. That's the main source of income. You'll see three highlighted areas: core funding, clinical director funding, and PCN leadership and management support. Now, they have all been rolled up into one now, and it's core funding of £2.92 per patient. That doesn't change the position as to how you remunerate the clinical director, and we'll come on to that on a later slide, but it's no longer being paid as £1.50 as a separate amount. You've now got this highlighted amount all being paid as £2.92. Enhanced access replaced extended hours, now paid through the network. That's £7.67 per adjusted patient. Now, adjusted patient is different to registered patient and weighted patient. There's a paragraph there which explains what adjusted population relates to, so I'll leave you to read that. Care home premium funding hasn't changed, £120 per bed per annum. Capacity and access support, £3.25, and then local capacity and access improvement, £1.39. Now, the local capacity and access improvement plan is an addition to the capacity and access support payment, and it relates to key components of modern general practice being digital telephony, simpler online requests, and faster care navigation. The last bullet point is the amount that's paid to practices, and that money belongs to practices. It does not belong to the network. This is the participation funding, and you should have a separate line in your practice accounts for this amount. It's £1.76 per weighted patient per annum, and that's based on your list size in the previous January, and that's your partnership income for being a member of the PCN. So just carrying on with current funding, I mentioned IIF money. The actual IIF money and points now have been reduced significantly. You were previously being paid on the basis of 262 points. That's now been reduced to 58, and it's based on £198 per point, subject to adjustments for list size and disease prevalence. Also, the number of indicators under the IIF regime has been reduced from 5 to 2. Lizzy mentioned the ARRS scheme, and it equates to approximately £22.89 total funding per weighted patient for the whole PCN. And the next slide is a brief table of the current reimbursable roles for 24-25. Mental health practitioners are also reimbursable between AFC bands 4 to 8A, and you will note at the very bottom of that table there is now funding available for enhanced practice nurses roles. There are specific requirements as to the qualifications that that nurse needs to have, and if anyone's interested in that, we can share the detail on that one later on. So moving on to a summary of the recap we've just been through. The PCN is not an entity in its own right. It's a joint venture or a loose partnership or a cost-sharing arrangement. This is on the basis that you've continued as you started from July 2019 and haven't introduced any other form of vehicle, which we'll come on to on a later slide. It cannot have its own bank account because it's not a separate entity. It cannot have its own payroll scheme, and it cannot be registered for VAT because it does not effectively exist. This really does present problems, which we'll go through on later slides, but the key action points are the 3 bullet points that you'll see at the bottom of those slides. The first one, make sure that you've seen copies of the network accounts from July 2019 onwards. If you haven't seen any, please make the appropriate inquiries with the network itself, the clinical director, and if any have not been prepared, I would strongly recommend that you have those prepared for you as soon as possible. Second bullet point, does your practice have access to the core records of the network, i.e. cloud accounting and periodic reporting? Again, if anyone needs any help with that, we'd be delighted to assist. And thirdly, have any payments been made to your practice in respect of profits earned since July 2019? Taking that one step further, has any PCN income been reflected in your partnership accounts from July 2019? So a bit of homework there for everybody. So that's the recap. I'm now going to pass back to Lizzy to cover off the exciting topic of VAT.
Yeah, I always seem to get VAT.
Sorry,
There's a lot of slides on VAT, people, so I probably won't cover them all, but we'll go to the next slide, Andrew, but I'll probably talk around it a bit more than obviously you can read. Everybody on this presentation should be able to read it. Anyway, just to note, the VAT registration threshold is now currently £90,000, but let me talk about VAT generally. So GMS PMS income is exempt from VAT. So this means you don't have to worry about VAT on GMS and PMS income because it's delivered by a health professional and it's provided to you to maintain and restore a patient's health. Okay, there will be some income you receive that doesn't fall into this exemption definition. There'll be things like some cosmetic work, for example, or some fitness 2 reports. So those things, they may be delivered by a health professional, but are they to maintain and restore their health? But then there'll be some other income you receive, like occupational health, getting someone, who's in work back to work, some private work, again, that falls within the exemption. So your first question on basically income is it GMS, PMS? It's exempt from VAT. If it's not GMS, PMS, is it delivered by a health professional? There's a list of registered health professionals. And is it provided to maintain and restore and protect a patient's health? Dispensing income is VATable. You charge VAT at 0 rate, so you don't actually charge any VAT. So basically, if you're a dispensing practice, you will be registered for VAT, which means you will have to charge VAT on anything like these fitness 2 type reports, medico-legal type stuff, because you're registered for that, and anything that doesn't fall within the definition, you charge VAT on. If you're a non-dispensing practice, you're most likely not going to be registered for VAT, because although you will have elements of VATable income, fitness 2, etc., it won't be above the VAT threshold of £90,000 per annum. You don't need to register for VAT. There are some exemptions to that. If you are part of a super surgery or a very large surgery, or you have some very specific sorts of income, then you may still, as a non-dispensing practice, be registered for VAT, because that type of income is above 90,000. So that's a recap on when you have to register for VAT and charge VAT. Now, I'm actually going to skip all the way to slide 22 to kind of explain what the VAT risk is for PCNs. So we've already determined that any income from your GMS PMS contract is exempt from VAT. So all your PCN funding, no VAT. Your ARRS funding, exempt from VAT. What we've got here, and this doesn't apply to a single PCN, but what we've got here in this PCN are 4 businesses who are effectively trading with one another. So Practice B is receiving its share of ARRS funding for a clinical pharmacist that they do not employ. So they are employing, or they are using that clinical pharmacist that Practice A employs. So they're making a payment to another business for provision of a clinical pharmacist. So Practice A is getting its share of ARRS income for clinical pharmacist, great, exempt from VAT, but it's also getting some money from practices B, C and D for that clinical pharmacist. So they need to consider, let's say it's a dispensing practice, so they're VAT registered already, they need to consider, should they charge VAT to practices B, C and D? So first of all, are they providing a member of staff or a service? So if they're providing a member of staff, then they would add VAT. And what I mean by that is they're saying, yep, you can have the clinical pharmacist on a Monday, don't care what you do with them, we're not going to control them, we're not going to tell them what to do when they're in your practice, we're just giving them to you for your share of ARRS income. So provision of staff, always you've got to add VAT on. If Practice A is providing a clinical pharmacist service, so they're saying, we control and manage this clinical pharmacist, they know what their role is as a PCN and what they're going to come into your practice and do, then clinical pharmacist is on the registered health professionals list. They are maintaining and restoring patients' health, so great, exempt from VAT. But if that person that Practice A was employing was like a PCN manager, not on the registered health professional list, or some other individual from the ARRS scheme, because not all of them are on the registered health list, then Practice A would need to charge VAT if it is already VAT registered, which means Practice B loses out at 20% of the cost. So it gets its full ARRS funding, but it's got to use its own profits to pay the VAT element to Practice A. It can't reclaim back the VAT, even if it's VAT registered itself. And Practice A doesn't get to keep the VAT, it gives it to HMRC. So as you can see, there is potential for VAT grit or a cost of VAT within this structure. If Practice A wasn't registered for VAT, wasn't maybe a dispensing practice, you may go, oh, well, great, we haven't got to worry about that. But remember, you've got this 90,000 VAT registration limit. So Practice A may still have other VATable types of income, and the provision of any staff, shared staff to practices B, C and D would add to that, and they could very easily trip over the £90,000 VAT threshold, which means they would have to register for VAT, charge VAT to practices B, C and D, and do all the faff that's needed for a VAT return. Like I say, if you are a single PCN practice, this isn't going to be an issue for you because you are one business and you're not trading with other business. The problem is, in most typical PCNs, you've got a number of practices, a number of businesses, and there is a flow of money between those. So the key point is you've got to look at all your members of staff, where they're employed, what they're doing. Is the practice that's employing them and effectively receiving the funding from or the other practices' share of the funding going to exceed the 90,000 threshold, and are you going to lose 20% of VAT? So this has been a problem right from the start, but of course right at the start you only had a pharmacist and a social prescriber, so it probably didn't have much of an impact, but as we've added more and more ARRS roles, it certainly has had an impact, and is why some PCNs are dealing with this. So what are your options? I think there's another slide. Or are you going to ask some questions, Andrew, first?
I was going to jump in with a question that we've received because it's a good time to ask it. So this is a question from Rachel. Hi, Rachel. And the question is, how does the VAT slide change if the PCN staff are jointly employed by all of the practices, i.e. all listed on that employment contract? Okay,
great question, can I just say? So if they are jointly employed and Practice A is just the paymaster, then there is a VAT exemption which covers disbursements, which effectively just means Practice B is paying Practice A its share of a liability that belongs to it. So you just need to check that you would be following those disbursements guidelines correctly, and then yes, you haven't got to worry about that. This scenario goes away. It does prove some issues, so I understand, for HR, and obviously for pensions as well, who's reporting the pensionable pay, and making sure, probably it's gone away now because it was making sure they didn't exceed full-time equivalent hours, which I think has now been removed. So yeah, if it agrees with the disbursement exemption, then you haven't got to worry about VAT on jointly employed people. Was that it on the VAT questions?
It was. Do you want to go back over those previous slides that we've skipped over, or should we carry on?
We'll carry on if that's okay, because we probably want to talk about incorporation. That's a hot topic. And I think that is one of the options where we've got some VAT problems.
Indeed. Okay, let's move on to the next slide then. And this is looking at the clinical director position. So it's one slide, nice and short, but the clinical director, him or herself, they provide the management and leadership of the PCN, and they are normally paid for their services. Now, the first question is the primary purpose of their role to protect, maintain, restore health? So this goes back to the VAT exemption point that Lizzie mentioned at the start of the VAT section. It's possible and that is possible in inverted commas, that they may be exempt from VAT by virtue of supervision of healthcare provided by GPs working within PCN member factors. And this is the key point. However, HMRC believe this is not the case and that VAT should apply. So the text in orange is really, really important. Each practice should consider its own VAT position and determine whether it has a liability and a requirement to register for VAT. To throw another spanner in the works, the clinical director, him or herself, the role that they fulfill, HMRC is also of the view that that role should be paid via PAYE, as the role is an office holder position. So this creates huge amounts of problems from a taxation but also a pension perspective as well. And I know that I've got at least one clinical director on the call today who we've looked at in a huge amount of detail, and that particular clinical director would gladly tell you, I'm sure, how difficult and problematic it is to get sorted. The most important takeaway today is that you take the appropriate advice over that role, how they are funded, and also the tax and superannuation implications. So that's something for you all to consider moving forward. I think, Lizzie, we're back to you now in terms of potential options.
Yeah, I think just following on from Andrew's slide there, when we did the primary care network presentation in Birmingham, you'll remember that, Andrew.
Scarred for life.
February 2020, I believe, just before COVID. HMRC were very clear on their positions on primary care networks and were engaging with us and our association ASMA to put out guidance, and then obviously the pandemic hit and it's been much more difficult, and HMRC have kind of changed their structure a bit to get that guidance out there. But as Andrew said, the top tip is really, check where you are on clinical directors and VAT. Have you got a problem? Can you resolve it? And what are the options? So what are the options? Okay, so I'm going to start with point number 3. Yeah, you could do a full PCN merger. So as I say, a single PCN from a VAT point of view isn't trading with anybody else. If I was being cynical, you might say this is what they perhaps wanted all along. It meets their working at scale desire. So yeah, you could merge as practices and have one big practice and one single PCN. You could use your federation. If you've got a local federation, you may use them to provide you with some services, provide them with staff. That doesn't necessarily make some of these options go away, but the federation may be geared up to do that. You may be able to take use of what's called a VAT cost sharing group, but you're unlikely, as a shareholder of a federation, you'll be like one of maybe a few PCNs within that federation. So you may lose some control. The federation would perhaps, you'd subcontract some of the services to the federation to provide. Of course, number 5, you could stay as you are, just being aware of the issues, getting them checked with when your PCN accounts are every year. What are the risks? What can you do to mitigate those? So number 1 is incorporate the PCN, which goes with creating what's called this VAT cost sharing group, because you need a limited company to be able, or a limited entity to be able to do a VAT cost sharing group. So this has sort of gathered a bit of pace of recent. So when we say incorporate your PCN, we don't really mean your PCN becomes a limited company. You can't incorporate a PCN, remember, because it's a DES. How can you incorporate a DES? So you effectively set up another company to run alongside your PCN, but you've got a separate legal entity, which probably you would use for your shared costs, which together with a VAT cost sharing group, which we're going to go on to speak about much more, can help you get around the VAT issue and some of these other risk issues as well. So I think we move straight into incorporation, don't we now, Andrew? Limited liability means that the individuals have a limited liability to debt. of that business. So you've got a business which is then a separate entity. Yes, you own it as a shareholder, as a director, you manage it, but if there is any unforeseen costs in there that the company can't meet out of its own income and assets, then your liability as a shareholder is limited to the value of your shares, the amount you guaranteed. There's a few different types of vehicles. You've got a limited liability partnership, an LLP, which sort of acts like a partnership, but you've got some limited liability protection. It's a corporate entity. Personally, I don't think it works very well in this scenario. There's a lot of disclosures that need to make. It tends to be used a lot by accountants and solicitors. You've got a company limited by guarantee or limited by shares. So a company limited by guarantee is one that probably mutually trades. Businesses mutually trade with each other, and this was used a lot for going back some years. Before out of hours was a thing, when practices and GPs did their own out of hours work, you came together with other practices and usually set up a company limited by guarantee to work together to fund those sessions, which would work in a number of scenarios for this because it's not dissimilar. But a company limited by shares just gives you a few more options later on in terms of if you're going to be making profits bidding for other contracts. A community interest company is really just a company limited by shares or guarantee, but within its articles, it has some asset locks, some good charitable kind of stuff going on. But yeah, company limited by shares is the one that probably sits best with a PCN and is most commonly used. So as I said, it's moving on, Andrew, a PCN is a DES, so not capable of being incorporated in its own right. So you'd still have your PCN. Your PCN would have all of its streams of income that Andrew just went through, and those accounts would show how that has been spent. You'd have your PCN limited. You would put in probably shared type services if you were maybe bidding for new contracts, anything that maybe is a bit risky in your limited company. And the PCN would basically enter into a contract with PCN Limited, say, okay, can you provide this for us? So as I say, in our opinion, initially, these have been set up as sort of workforce companies. So the staff are all employed in your limited company, maybe transferred in. Great for them. They're all under one employer. There's no one practice having all the risk of being the employer because you've got a PCN Limited, a separate entity that employs them. And your PCN is merely paying PCN Limited for those staff in the same way as it may pay a third party for a pharmacy service or pharmacist. What are the kind of steps for this?
Just before you go any further, I'm going to take you back a slide because we've had a really good question from Gary.
Okay.
Hi, Gary. The question is, can you explain the differences between limited liabilities of a CIC compared to a company limited by shares?
The liability at the end of the day, if there was a kind of insolvent position, I'm guessing we're talking about.
That's what I would assume, yes.
I'm not sure I can actually answer that, Andrew.
Well, the structure is fundamentally the same in that it's a corporate entity. The difference between a CIC and a company limited by shares is basically what is said on the slide.
Yeah.
Exactly. The CIC it has the emphasis on using profits and assets for the public good. So the CIC doesn't really fit with, if you like, the partnership model, whereby the partners are in partnership looking after the GP contract that they have to look after the patients and obviously make their income from that contract. If it's a CIC, some of the profits need to be retained within the CIC and spent within the locality. It's not then available for withdrawal by the members. So that is the fundamental difference. And you tend not to see CICs used for this purpose simply because it doesn't follow the typical position of a partnership providing or looking after a GP contract and the citizens of the locality?
So you've just given me 5 minutes or a few minutes to think about this as well. So it's still a limited liability entity, maybe limited by shares or by guarantee. So your articles will say, what your liability is. It will be either the value of the shares or the value of the guarantee. So your risk profile has to be limited to that, assuming that the directors haven't traded knowingly insolvent. They knew they were going to come out of the position, and they haven't breached the rules over the CIC rules over asset locks and dividends distributions. So I hope that answers your question, Gary. If not, let us know and we'll do some further research for you on that. Yep, okay. So on incorporation, yep, you would set up a separate legal entity with Companies House and HMRC. So you've got your separate legal entity. Remember, you've still got your PCN. So your separate PCN Limited is able to employ staff because your joint venture can't. It is able to apply for a PAYE scheme. Probably you transfer your staff, existing staff, into it. So all the staff in your PCN Limited would have the same terms and conditions, and they would have the same boss, effectively the same employer, which probably feels a bit better than if you've got ARRS staff maybe employed over several PCN practices. The common question is, can they access the NHS pension scheme? And the answer is yes. There are 2 different ways you have to deal with this. Well, actually, there's several ways you can deal with it. But you can have what's called open and closed access. So for the staff who are already employed in your practices, already in the NHS pension scheme, they get like a golden thread, which means they will be allowed, you have to apply for it, to join the NHS pension scheme, but they're closed access, which means it's only for that group of people. And then you would apply for an open access scheme for any new and future employees. And there's a couple of different directions that you can choose to do that, whichever one you feel like fits you better. So you've then got your limited company. You'd open the bank account, and the nominated practice should transfer the funds into that bank account for payment of shared services. The limited company will need to prepare its own sets of accounts, which will be filed at Companies House. So unlike your own practice and your PCN accounts, these are filed at Companies House. So other people who are trading with PCN Limited can ensure you're compliant, ensure you're solvent. Corporation tax rates are lower than income tax rates, but this is probably not the reason you're looking at PCN Limited, because I'll come on to if PCN Limited will actually make a profit in a moment. But it could bid for other services and make a profit. There's a reason why it wouldn't make a profit for PCN shared costs. But yeah, it might bid for other contracts, make a profit on those, pay the corporation tax, which would then be sheltered in the company from income tax rates. Income tax is only payable when monies are paid out of the company to individuals. Pros and cons of incorporation. Big pro is you've got limited liability. So you're managing risk because you've got that limited liability to your value of your share. Now, I can see here we've got a separate entity capable of entering into contracts and the potential to take on additional contracts. We're so keen on this one. We've mentioned it twice as a pro. Yeah, you can then, you've got a separate entity that you can do whatever you want to with the future. Bid for contracts, provide back office functions. You don't have to limit it to the PCN shared costs. But having your shared costs in this PCN Limited does allow you to look at the VAT cost share group, which I'm going to come on to, which is where it mitigates that VAT risk that we talked about earlier. Cons, yep, you've got to set it up. There's going to be some TUPE costs. The accounts are available on Companies House, so you've less privacy. Directors have to follow their responsibilities, and you need to set it up properly at the start with good articles, shareholder agreements, like you've got your own partnership agreement. So there's any disputes at the end of the day, you can just dig those out and remind yourself what you agreed to.
Sorry, there was a couple of points I would add to that as well. So just going back, the cons of a limited company is, or one of them is, if the company makes a profit, and Liz is going to talk about whether it make a profit or not, but if it does make a profit, it's 25% main rate of corporation tax before any profits are paid out to the shareholders. So immediately there's a tax there that you are incurring, which is difficult to avoid if you are making a profit. The other thing is if the network via the limited company does make a profit, one of the stumbling blocks that we have seen is how the members then agree on how profits are distributed amongst the members. So you could have a scenario where some individuals are keen to take as much profit out of the company as possible, and others who don't want to take the money out because it increases their tax and superannuation liabilities. So that's one of the biggest stumbling blocks that we have seen. So just wanted to add those in, Lizzie.
Yeah, and obviously if you don't take the profits in the year they're made and they're taken 5 years later, have you still got the same partners in those who own those shares in the practices? So handling shares is a tricky one.
It is.
Okay, so that cost sharing group, I said I'd come back to this. Remember that slide where I've said you've got these different businesses trading with one another and you've got the cost of that being added on. So what does a cost sharing group mean? What does it do? So basically it says if you've set up a separate entity, which tick, we may have done if you've set up PCN Limited, and you've got costs in there, or your staff, that are being provided downwards to all of your shareholders, which in this case would be your member practices, then we can ignore VAT. We haven't got to think about if it's a staff, if it's a service, if they're registered health professionals and what they're doing. So it only works one way. So you've got to be careful that you don't go the other way up. So if you've got a practice who is providing some PCN management support or some finance support, they bill the PCN, there's still a VAT issue there. You really need those costs, those people in your PCN Limited company. But yeah, your steps, there's a few more points you've got to tick to make a VAT cost sharing group. But it's mainly that you've got some people, some businesses working together, you've got a legal entity, and you are not making a profit. You are providing those services at cost. So this is where I said, will you be making a profit that's subject to corporation tax? Not if you want to meet the VAT cost sharing group for shared services. So it means you've got your staff in the limited company and the PCN is just paying for the cost of those staff. It's not paying for the cost of the staff plus 10% or 20%. It's just paying the cost of the staff. So those limited company accounts would show income from the PCN and the expenses for the staff and zero profit. But yeah, your first step would be incorporation, and then to keep a check every year that you're working towards the cost sharing group rules.
Just skipped on to that last one, Lizzie, a couple of points on there about no requirements to notify HMRC.
Yeah, so there's not a clearance process, which is why we say, just check every year. But, where we work with PCNs, we'd be preparing the limited company as well to obviously make sure that there was the no profit. And you've just got to think about, as I say, it works one way downwards, not the other way. You may still have some VAT if you've got subcontract arrangements, so your limited company is subbing from someone else. And all your PCN practices do need to be involved. I think there's a grace period, but as I said, there are some other little hoops to jump through.
Okay,
brilliant.
Thank you, Lizzie. Before we go to the next slide, we've got a question from Scott, which I was going to attempt to reply within the box, but it's going to be quicker for me to deal with it now, or between us, I should say. So Scott's question is, if there are profits being paid out to member practices and there has been a change in partners, how does this work for previous partners? Excellent question, Scott. So if it is a loose collaboration, the network, then we talked about identifying the profit generated by the network. that share of profit belonging to each member practice is recognised in each member practice's set of accounts. We bring in a debtor provision into the accounts for the amount owed by the network to the partnership. It's then for the partnership to decide, in the same way that any other income and expenses are allocated, how that surplus is allocated between the member practices, between the partnership members, the partners of the practice. With basis period reforms, all practices now will be preparing accounts the 31st of March. That will coincide with the PCN year end as well. So we should avoid the situation where you've got potentially a practice with a different year end to the PCN and the discussions to be had over how those profits are allocated between the members. So it should be easier going forward. However, if PCN accounts have not been prepared for previous years and that surplus has not been recognised in the member accounts, then there probably needs to be some thought given as to what do we do with that, because you've got to be fair to all partners. If they were partners of the practice, they were contributing towards the network, it's shared in the normal profit sharing ratios, then there does need to be a conclusion as to what happens on income relating to previous years and who benefits from that. So again, if you've got any specific questions on that, please let us know. With the limited company has the potential to retain profits within the company and not make distributions to the shareholders. And this is where I talked about the difficulty in terms of, do you distribute all profits out to members, bearing in mind that members are only receiving income after corporation tax has been paid? Or is there an agreement between everybody that actually, no, we're going to retain all the profits within the company, we'll use that for future expenses, future benefits, and there's no distribution to be made to individual partners or individual practices? That's really difficult. Quite often, that's the biggest stumbling block that we see, how individuals are allocated shares and how individuals are remunerated by that company. So that's probably the biggest stumbling block that we see from moving from that loose collaboration into a limited company arrangement. So Lizzie, anything to add to that, or have I covered that?
Yeah, I'll just say with the limited company that if you want to make use of the VAT cost sharing exemption, which would be one of the main drivers for creating a PCN Limited, then we don't want profits left over hanging around in PCN Limited, because it will break the rules of the VAT cost sharing group. So if there's money still left over in profit in the PCN, that would still sit in the PCN, not in the PCN Limited. Yes, it doesn't shelter that income from income tax in the same way, but as Andrew said, it's difficult within a company structure anyway, where you've got a number of people with differing needs and wants involved, but would be a consideration in the future if your company maybe did other stuff, and would need to be covered off as what you want to do in your shareholders agreements on day one, I would say, rather than think about it when it's happening.
Thank you, Lizzie, which leads us nicely into what comes next. So what does come next? Okay, so you're probably aware that GPC England have issued a non-statutory ballot, which will close on the 29th of July to support industrial action over the changes being made or already made to GP contracts for 24-25. If that ballot is successful, GPC will invite GP contractors to talk things through with their practice teams and, working in liaison with the LMC, determine the actions they will be willing to take. Now, the 24-25 contract was imposed on general practice, and the terminology used, it's seen as a stepping stone for what comes next. One of the questions is, will we see the end of PCNs? I think Lizzie and I's view is that this is very unlikely, and working at scale is definitely here to stay. We also have the fly in the ointment of the general election, which is taking place on the 4th of July. So the manifesto pledges have been released by the three main parties. And you'll note from these next slides, there is no mention of a brand new contract by any of them. So just to look through the three parties, Conservative manifesto, not sure how they're going to achieve this, but they intend to build or modernise 250 GP surgeries. You can probably tell there's a little bit of cynicism in my voice. They want to build 50 new community diagnostic centres to provide an additional 2.5 million checks per year, and expand Pharmacy First to free up 20 million GP appointments per year. No comment on that. Next slide, Labour. They want to move to a neighbourhood health service with more care delivered in local communities. They want to guarantee a face-to-face GP appointment for all those who want one, and to incentivise GPs to see the same patients to encourage continuity of care. How they're going to do that with the current workforce, I have no idea. They also want to establish a community pharmacist prescribing service, granting more pharmacists independent prescribing rights and enable other health professionals to make direct referrals to specialists. So those are the two main parties. We then have the Lib Dems. They want to establish a right to see a GP or most appropriate staff member within 7 days or within 24 hours if urgent. Give people aged 70 years and older and those with a long-term health condition access to a named GP. Extend prescribing rights for qualified pharmacists, nurse practitioners and paramedics. Establish a strategic small surgeries fund to sustain services in rural areas. And review the schedule exemptions for prescription charges. So as I said, no mention whatsoever of a change to the contract, no significant overhauls. I do think that PCNs are here to stay because we've gone so far down the path. Lizzie's first slide was looking at funding from inception in July 2019 to where we are now. This working at scale model is not going to go away. For those of you that are considering operating models, I know that some of you have been waiting to see what happens at the end of that 5-year DES. We've got another year of imposed contract. I think we just have to wait and see what comes if and when there is a change of government and what comes after that. But I don't have a crystal ball, I'm afraid. I can only tell you where we are. But I do think that PCNs, or at least PCNs in a certain guise, are here for the long term. So that is the conclusion of our slides. It is 2 o'clock, so we are up to our 1 hour limit, but we do have time for any other questions if anyone does want to jump in.
So there was a question about should there maybe have 2 limited companies, one for profits and one without. Sorry, I probably misguided you there slightly. No, you don't need to have 2 separate companies. So as long as your shared services that's in your limited company are provided at cost to all the PCN members and meet the VAT cost sharing group, you can have then for-profit services in the same company, and the VAT of that would be looked at differently. But you'd need to obviously just make sure the accounts showed both lines of income and services. It's just if you were making a profit on your PCN, that wouldn't be in the limited company.
Just last couple of slides. We would love to hear your feedback, so please get in touch with any feedback you may have, positive, negative, indifferent. Always nice to speak to you all in person. There are our contact details on slide. It's a rather younger version of me. That is definitely Lizzie, looking as glamorous as always. So there are contact details, but by all means contact us via our website. We are committed to you, and I'm afraid I do have to pop up the disclaimer slide on our screen. This is not specific advice to any of you, it's generic advice. If any of you would like to have specific consultation with us or talk about specific matters to your network, we'd be delighted to hear from you. So I think, Lizzie, that's us done for this afternoon. Thanks everyone for attending. We hope you found it useful. Have a good day.
Thank you.